And we really have a privilege of having Heather Jackson from Dougal Camaraderie come and speak to us today. Heather has got a real passion for taxes and financial success, and she's had 23 years of experience advising businesses and individuals on tax and accounting strategies. She also goes and testifies before the state of Oregon and sometimes the federal government about tax laws and changes. And so today she's going to be talking to us about the SAVES Act and also a little bit about some other legislation that's in the act that is coming up that can affect us in Washington County. So Heather, please take over.
Alrighty, thank you, Kevin. Let me get the screen up. Share. Alrighty, here we go. Well, thank you guys for having me here. I appreciate it. We're going to cover Oregon Saves will be most of the time of our discussion. If you have questions, feel free to come off of mute and ask your questions. You can also post them in the chat, and I will try to watch that as well. Thank you, Kevin, for posting the slides. The big thing is the Oregon Saves is for employers and employees. I'm going to cover both parts with an emphasis on the employer part of it. We're also going to talk about some of the local taxes, the deductibility of meals, and then we have questions at the end if people aren't asking them during the presentation. So for Oregon Saves, the big thing to know is if you are already providing a retirement plan option, Oregon Saves is irrelevant. If you have a 401k, a simple IRA, a SEP IRA, a profit sharing plan, there's also, deferred comp, there's all sorts of vehicles for retirement plan. If you have any of those in place, you are not required to follow Oregon Saves. Oregon Saves is just one more option to employers to provide retirement savings for their employees. It's an option to what plan you pick. You just have to pick a plan based on some dates. So basically the employer deadline, which is on this side where we're at right now, the employers with 1 to 4 employees, the target date isn't officially set. It's just later this year that you have to have either a retirement plan option available or Oregon Saves. They haven't set an exact date with COVID. This date is actually moved 3 times. So, at some point this year, it will be mandatory that all employers with employees have a retirement option. So that's where Oregon Saves comes in. I think for some people is trying to give the option and let people handle it themselves. You can see they tiered it in. It started way back in 2017 with the larger companies, and they've been slowly rolling it out, and we're now to the final stages of mandating this. This is the eligibility for the employee. They have to be at least 18 years old. They have to have earned income. There's no special hour requirements and things like that. They have to be employed in Oregon, and they have to be employed for at least 60 days. So there is a waiting period, just like most retirement plans, before they can join the plan. The fees are to the employee. It's about 0.25%. So every $100 in the account will cost them about 25 cents. The things to know as an employer, they are very generous in the sense that basically the employer has 2 requirements. They have to get themselves set up on the Oregon Saves website, which means you need, I think, 3 pieces of information. You need your EIN, you need a letter from them, or you can call them and get the code. And then you need your name of your employees and their social security numbers. Basically, the employer just needs to go on the website, add their profile as an employer, and then add their employees, which then notifies the employees that they can log in and either accept or decline the Oregon Saves. There are no fees to the employer. It's a free service. The other big inconvenience is the contributions, the employer is required to upload the contributions either from their payroll provider in, or maybe it's them doing the employer doing an ACH in. There is no employer match. There's no employer contributions of any kind. It is only the employees allowed to defer money into the retirement account of Oregon Saves. Those are the big items from the employer standpoint. It's pretty low maintenance. If your employees have questions, basically your answer is talk to Oregon Saves. They have some investment options in it. They have some defaults. So there's there's kind of some ground rules in it, but it's not the employer's responsibility. If your employee stops and starts, you will get notified as the employer. The Oregon Saves program lets you know that they have stopped or started contributing or wanting to contribute or not to contribute anymore. The plan is set up so that the employers have as little requirements to do as possible. So if you're looking at it from an employer standpoint, this is the least burdensome to the employer. Okay. I wanted to just tell you a little bit about from the employee side of it, because you may get asked some basic questions about it, or as you're looking at it from an employer standpoint. Oregon Saves is a Roth IRA account. It follows all IRS rules. It is a maximum contribution for a year of $6,000, or if you're older than 50, then it's $7,000. These are all 2021's numbers. There is a default savings rate of 5% of gross pay that you can change at any time. There is also a button for automatic increases, and you have to elect out of it. It's a 1% automatic increase every January 1 of each year until it reaches 10%. So you start at 5%, and over the course of 5 years, you're up to the 10% contribution of gross pay. It does, like if you're running it through payroll, it does, as soon as they hit the 6,000 or the $7,000 number, the withholdings stop and your requirement to put the money in stops. Then the employees audio enrolled after 30 days. So basically they have a various, it's not an expansive list of investment options, but they have some. And if the employee doesn't enroll in something, they automatically get target funds based on their age. And the plan automatically puts them in to those target funds. The people are also enrolled automatically. So if an employer goes in and sets up all their employees, let's say on January 31st, this plan's rolling out. If the person hasn't opted out, the employee hasn't opted out by the end of February, they are in the plan and they have to physically do something to get out, and they will be at the 5% deferral rate. We've talked about it can go in and out. The account is portable, meaning if they work for one employer, work for another employer, it's their account. It isn't tied to you as an employer. It is like what I'll say is a Roth IRA. That's a normal Roth IRA. It's theirs. It just happens to be in an Oregon Saves program. There is limitations to contributions. So this is where the rules for the Roth IRA still come into play for this account. So if a single person makes more than $125,000 modified just to gross income, which we'll talk about in a second, it starts phasing out. For a married person, it's $198,000 and starts phasing out. So people with larger incomes, this isn't even available for them to use, even if this is the employer's plan. So this is a bit different than like a 401k or a SEP or a simple, where everyone can participate no matter what your income levels are. If for some reason an employee has contributed and they shouldn't have, they are allowed to recharacterize it into a traditional IRA within the plan, meaning they're not going to have to pull the money out and be subject to penalties and things like that, even though it's a Roth IRA. There's potential penalties and such. They can just roll it into a traditional IRA within the Oregon Saves plan. So that way they don't have to pay penalties if they contributed and shouldn't have. Alrighty. Any questions so far? Wonderful. There we go. So I just wanted to explain adjusted gross income a little bit, because that is a word that a lot of people hear and I get a lot of questions on. Basically, this is the worksheet that is how to get there. The first line is adjusted gross income. That number, I think most people are familiar with from your tax return. That is it's after deductions, basically. It's your adjusted gross income before like your standard deductions. Then you get to take into account student loans and some other items. They're all listed here, and that's what modified adjusted gross income is. So if people are kind of on the line or close, they could kind of walk through this calculation and see if they're eligible to contribute to the Oregon Saves. Any questions on that piece?
I've got a question. What if your employee just wants to do their own Roth IRA or has their own Roth IRA and doesn't want to go through Oregon Saves? Can't you, as an employer, are you all right with providing the opportunity for it and they can deny it? Is that still the case?
Yes. So my recommendation to employers that have employees that are doing what they want to do is you sign up for Oregon Saves, you add the employee, they deny the coverage, you as an employer are covered, and the employee can still do what they want to do.
So basically, as an employer, we need to put our employees in whether they choose to do it or not, and then they can opt out. So
yes. And I recommend that the employer, if they're doing it, they at least have a very, very big meeting or at least a very detailed discussion about it, because the minute they sign up, they have 30 days and then they're automatically opt-in, which means you're doing the withholding at 5%. So it's something that is a big deal from an employee standpoint. So there just has to be a lot of communication when the employer signs up. That starts the clock of the 30 days.
Heather, I have a couple of questions. Does Oregon Saves have like folks that come out to the employers and meet with employees, so that this isn't something that the onus is on the employer to know and understand the program, to be able to explain it to their employees? Like if you're buying or getting a health care benefit, you can have them come out and they do the talking because they're the experts in that.
When this all started, the answer was yes. With COVID, I am not sure. I have heard that they're willing to do some Zoom meetings or some conference calls, but it is a lot different than it was, 3 years ago when this kind of was a bigger deal in the sense of people getting used to it. But I do know they will do those items. It just may look a little different.
Got it. And you might have mentioned this and I might have missed it. The penalty for not doing it. So if you're a small employer and this Oregon Saves program is not on your radar and you didn't come to this workshop today, what's going to happen to you?
At some point, the penalties will come into play. They haven't defined them very well, let's put it that way. So there is a penalty based on wages is the last I saw in a draft format, but they are looking to basically penalize employers for not doing this because it is mandatory.
Got it. Okay. Thank you.
Yes, and I actually recommend that all employers, if you have a 401k, a simple SEP, whatever, log into Oregon Saves and check a box that says I'm an employer that has a 401k, simple SEP, whatever, and get them off your radar, meaning you're clear and clean. So like our firm, when I got the thing, I accidentally went on, said we already had a retirement plan so that we're not harassed and there's no penalties that they could come assess because we already had a retirement plan. So if you are an employer that already has a retirement plan available, go on, log on and get you checked off that you have one.
sorry, Heather, one other question. So you said this isn't affecting businesses yet between the employees 4 and under. Can they go ahead and do it now just to get ahead of the game?
Yes, because the date they set is the date it has to be done by. So at some point later this year, it will be mandatory. We just don't know the date yet. So the sooner you do it, the better, just because at some point this date's going to appear and you have to comply by that date.
And for those of you that did come on late, Heather provided us her slides. I put it in the chat. If you click on it, you can download it right to your computer. So you'll have the slides and the information that she's covering today.
So Heather, I have one other question. I guess maybe it's more of a comment. Is this done through this Oregon, the Treasury, the State Treasurer Department? Is who's implementing this program and sort of?
Basically, yes.
So why do we have so many things that are like, well, we haven't decided that yet. This is still in draft form, and yet we're still kind of barreling down towards a deadline. Because I think that even promoting the program we have today, people don't have a clue what we're talking about when we say Oregon Saves. They don't know. And so I'm concerned about, that all of these things are sort of in flux. And so employers are trying to figure out, number one, they didn't, again, it wasn't on the radar that this even moved forward. And now they're, looming deadline of what that's going to look like.
Right. It will be interesting to see what happens, because some of the reason the date keeps changing, one of it is COVID, but the smaller businesses are the community they're having trouble with. The outreach is not top of the notch for them, and they know it. So that's some of the other reason why the smaller businesses 1 to 4 are keep getting pushed, is because the outreach is important and they have to get it done to be able to keep moving forward.
Yeah, it just seems like small businesses, have been, I would say, a little preoccupied with other things.
Yeah.
Than checking the box, right? Yeah. So anyway, but I think that we are recording this program, so we will be sending it out to our our network to hopefully spread the word about this program and get it on the radar of our small employers. To your point, it's better to have all it taken care of, rather than wait till the deadline and try to figure it out.
Right. And so kind of like my biggest recommendation to any employer is talk to your CPA, talk to your financial advisor, talk to who your trusted advisor is as you're trying to make a decision about these plans, because you have other options. And if you're the sole employee, the owner and employee, maybe Oregon Saves isn't the right thing for you, and we do something else. And then you get to check the box that you already have a retirement plan. So there are things that you can still put into place. So I really recommend people, reach out to who their trusted advisor is and start working on this now, because this is something that, is going to impact businesses, whether it's if they get it done this year, if they get it done next year, but it's looming and it's kind of hanging over everyone's head.
And Heather, I just want to be clear, because this is something that, some people are going to ask. The Oregon Saves, they select the funds that are available for that program. It's not like you have your financial advisor and you can pick and choose the, various different accounts. Is that correct?
That is correct. You have a pre-populated list to choose from. And they do have target date funds. So, and then they have some others. Okay. Any other questions on Oregon Saves? Wonderful. A couple of things I just wanted to bring up, because here in Oregon, and especially in the Portland metro area, we've had a lot of new taxes hit. And one of the jurisdictions, City of Portland, Multnomah County, have been more aggressive because now they have access to Oregon and federal tax returns for everyone. So I just wanted to cover some local taxes. That way people are not taken by surprise. They've at least heard of them. They can talk to their advisors and such. So I have them all on this next few slides. So the new ones that affect 2021 are the Metro Supportive Housing Services and Multnomah County's Preschool for All or Daycare for All. Last year, we had the corporate activities tax, which is a gross receipts tax with a few deductions, called CAT. And then I do want to touch base on the city of Portland real quick. And this is really meant to be a very, very high overview, but just enough so you guys know what these are and have heard of them and know if they apply to your business. So we'll start with Metro Support Housing Services. This is at an individual level. If your Oregon taxable income, they start with the Oregon return, is more than $125,000 for single and $200,000 for joint, and I've defined those right here, there is an additional 1% in your personal income tax. That is a separate form. There's separate estimated payment vouchers, because if the amount is more than $1,000, you have to make estimated payments. There is a special form, but then there's also some special rules to it. This tax applies to residents and non-residents of Metro. Metro is considered to be Multnomah, Washington, and Clackamas counties. On the website for Metro Supportive Housing Services, they actually have, if you go onto it, you can type in your address and see if you're within Metro. You have to be pretty much out of these counties to be not considered Metro, unless you're in, like, you know, some of the rural areas of Clackamas and or Washington County. Sole proprietors, even though they are considered a business, are considered individuals for this tax. So they don't have any special rules. Businesses are taxed at gross receipts over $5 million. So if you're a business, they have a tax and it's the same 1%. The Multnomah County Preschool for All, it has similar rules as the Metro one. It's the same income limits. The difference is there's a 1.5% personal income tax on your income that is in Multnomah County. If you're a resident and a non-resident, you have a little bit different rules, but it's based on your income either as a resident or a non-resident. But they added a separate little section here where if you make over $250,000 for single or $400,000 for joint, 1.5% is added to the income above those amounts. So you pay an additional 1.5% in tax. This taxes, both of these taxes tax your W-2, your interest, your dividends, stock sales, all of that, whatever is in Multnomah County or Metro, if you are a resident of either of those. If you are, let's say you live in Washington County and you do some work in Multnomah County, then only the work that you do in Multnomah County is considered for this tax. So you have to kind of look and see where your income is earned. But residents of the county, Multnomah County, and the residents of Metro, it's all your income. Again, sole proprietors are considered individuals for this tax. And as an employer, this is some of the reason why I bring it up, is if you have employees that make, you know, more than 125, 200,000, there's mandatory withholding that starts this year for this specific tax. So, those are the two new taxes for the 2021 filing season. The one that we got added to us for 2020 is the corporate activities CAT or CAT tax. This is on individuals and businesses with gross receipts, less deductions over $1 million. So this doesn't apply to small businesses and things like that, but just be aware of it. And the tax rate is 0.57%. plus a $250 fee. So this one is for larger businesses, but just know some of your invoices may say CAT or corporate activities tax, and they add the tax to your invoice. So this is what it's doing. Last but not least, the city of Portland, Multnomah County, these have been around for many years. The big issue with them is because the city went through a major upgrade this last year, they now have access to everyone's federal and state tax returns. So if they believe you're in Multnomah County or the city of Portland, they can look up through their system and see your federal and state tax returns to see if you have a filing requirement with them. This is new. So many people who haven't been filing maybe should have been and now could be caught. There are exemptions to this tax. So in Multnomah County, if your gross receipts in your business are less than 100,000, you're not a filing, you have no filing requirement there. The city of Portland gross receipts exemption is 50,000. There is a minimum $100 to each of them. If you're in and you're not exempt, there's a lot of exemptions for different types of businesses and things like that. I didn't want to get into all of that, but just some basics about the city of Portland. This one is a bit different. This is calculated based on where the work is done, not where your clients are located. So if you're sitting in Washington County and never leave Washington County and all your clients could be in the city of Portland, you still have no filing requirement. Any questions on those 4 new taxes that I know I covered them very high level and very briefly, but any questions on any of those?
I guess just one thing I would point out is, since we were talking about the Multnomah County Preschool for All, there is an effort underway to have something similar to that in Washington County that would potentially be on the ballot in November of 2022. So in November of this year, it needs to go through the Washington County Commission for approval to put it on the ballot. But
Yes.
and that the interesting dynamic, I guess, of the, if you're located in Washington County, but you do business in Multnomah County, you can't be double taxed for that. So that's creating a bit of an issue, and as to how that's going to sort of pan out, because that diminishes that the effort in Washington County. And Multnomah County is certainly not going to say, oh, never mind, we'll take that part out. So it'll be interesting to see how that's all worked. But I appreciate you're laying it out, because we're going to be reviewing what that proposal is like here in Washington County pretty soon.
Yes. Yes.
I do have a question. I'm assuming these things that apply to individuals who, like employees who might live in Multnomah County, does the employer have to withhold taxes for that, or that's just on them as they do their end of year tax preparation work?
So I'm pretty sure, let's make sure I'm right. Yeah. For the Preschool for All, it is mandatory withholding for the employer to withhold if the employee makes over, I believe it's 200,000 for a year. The employee can opt out, but you need to have a thing that says they're opting out. The other piece to this is if you have an employee who maybe makes 125,000 or 130,000 and they're single and they know they're going to owe the tax, they can opt in and start paying in on the tax. So you can opt in and you can opt out, but it is mandatory withholding at 200,000.
Just to clarify, so in this particular one, and I think, Mary, the question, and you can correct me if I'm wrong, but if the employer is in Washington County and an employee works for them that is in Multnomah County, then that's their requirement. It's not mandatory for a Washington County employer to report that tax for that employee that happens to live in Multnomah County. Is that correct?
That is correct.
Not yet, at least.
Yeah, I was gonna say at this point.
Yeah, but I am.
But I will say that with Intel being in Washington County, and many of Intel employees potentially work or live in Multnomah County, it's becoming a big deal.
I was going to bring up the Clark County issue as well.
Okay.
because I think that, I mean, I read an article about that as well, that they're, looking at how they can, capture some of those employees that work in the state of Oregon and live in the state of Washington and don't, and sometimes these things don't apply to them.
Yes.
So overall, what we're saying is the state of Oregon is going to try and figure out how to get our money.
Yep.
Heather, do you know by chance what has been the revenue generated through the CAT tax?
Oh, I did. We had a big, huge announcement about it. It was more than projected. I was at the presentation of the check. I don't honestly remember what it is, but it was more than it was supposed to generate in the first year. Any other questions on that? I thought I would just also mention quickly, Oregon has a kicker this year. It's over 17.3%. And that will get credited to your Oregon tax return, kind of like a tax payment or a tax withholding. So some of you may see either a reduced amount of taxes due or a larger refund than expected, but the kicker is here and it will appear on your 2021 tax return. I know, largest kicker yet.
So since the money that was collected for CAT was more than what was anticipated, so any chance that either going to reduce the rate or just return the money
For the kicker?
for the CAT?
Oh, for the CAT? No, they are not. They have to let it run for 3 years and then they can reevaluate it. And then at that point, it's actually scheduled to go up, not down at this point because of their predictions and such. It is scheduled to go up at the 3-year mark, but they will be evaluating it. Any other questions?
That's a great question about, I mean, being a skeptic that I am, I kind of knew the answer that they're never going to give you anything back. But at the 3-year mark, what the process of evaluating that need for an increase, is that something that a business organization like the Washington County Chamber could engage in that conversation, or is it really done at the legislative level?
So what happens is so at the 3-year mark, this is the best part about it. And I will be as optimistic as I can. At the 3-year mark, they have all the data they need to actually analyze it. So in October of 2023, they finally can start analyzing the data from CAT, which means in 2024, 2025 is actually when all the data gets analyzed and reviewed and taken into consideration. So just because I say they're going to analyze it at the 3-year mark, that means it's like year 4, year 5, as they're coming up with the details. So the increase could happen anyway before they do anything because of the time it takes for them to analyze the figures, the facts, and come up with what they're going to do, that increase could still be there before that happens. And yes, you can get involved. They actually go through a whole committee thing. There's a few of us that sit on a committee that's in the early stages of it, but they do bring it out to public. If you're involved with any of the legislative stuff, they will send announcements out when they are going to put it out to public.
Excellent, thank you. It's one of the taxes that has had the longest, I guess I'm not even sure how to frame this, the most consistent complaint level that I've heard. It keeps coming back up and they keep coming back up and what can you do and when's it going to stop? And so I'm not sure if you as a CPA have heard that from your clients as well, but yeah.
I was actually, so I work, as Kevin introduced, I sit with the legislature, the CAT tax, that bill was my bill to babysit through legislation. It didn't matter what we said, what we did, any presentation we did, because it was a gross receipts tax. We did have some influence on it. It got better than what the original bill I read was, but they are gung ho on this thing, unfortunately. And, you know, each year we're tweaking it a bit, but it still has some ways to go.
Well, thank you for being a part of that conversation. I know that it was a big lift to try to create any sort of narrative around, you know, what this might mean. But also there is the other side of it, which is also the deliverable piece. What are we paying for? And that's where also some level of accountability. And, you know, I hope that the data is also going to show sort of how the dollars were spent. And
Yes. And they will have more of that information, I believe, starting this year about where dollars are spent a bit better. But they are mandatory reporting to this committee where it's spent and where it's trackable. So it does have some, you know, checks and balances, I guess, on how they're spending the money, which is unique to most of the taxes. Any other questions on that? I know probably not what all you want to hear about on a Wednesday morning is all the taxes that Oregon has put into place in the last couple of years. Sorry about that, but I figure you guys should hear about them. The last thing I wanted to just mention was the deductibility of meals. With the Consolidated Appropriations Act in 2021, they allowed business meals to help the restaurant industry to go from 50% deductible to 100% deductible for 2021 and 2022. If it is not a restaurant, then it still applies to the 50% rule. As a reminder, entertainment since 2018 is not deductible at all. That's your, you know, box tickets to events, any of that kind of stuff. Those are entertainment now. I wanted to define restaurant because it's kind of an interesting definition. A restaurant means any place that prepares and sells foods or beverages to retail customers. Basically, I'm not sure what they were trying to get at, but basically, if you go to a restaurant, it doesn't even have to be a sit down inside restaurant. You know, your Starbucks, your Taco Bells, I mean, all count as a restaurant. What doesn't qualify is I listed it in the last little bit, are grocery stores, your specialty food stores, liquor stores, convenience stores, vending machines, and kiosks. Basically, if it's those items, they don't qualify and they will still apply the 50% rule. But everything else that's in the restaurant industry will be 100% deduction for 2021, continuing into 2022 to help the restaurant industry come back. So if you haven't heard about it, I just wanted to make sure you knew as business owners, you do a lot of networking, there's meals involved. It's a deduction that, you know, everyone should get the best answer for. So any questions on that one?
So Deanne, that would be a good push for us to, you know, promote our restaurants in our chamber. So go visit them, write it off as a business expense. You get 100% write-off. Support them this year.
Right. So, alrighty.
is there any chance that's going to get extended based on Omicron? And I know that the restaurant industry is also, you know, at the federal level trying to get additional relief based on the fact that they've been, you know, continue to be impacted. Are you hearing anything that might extend any of these?
I've seen, it's been interesting. I have seen two versions. One version is this just extends into, and they did it 1 year. Then I've also heard them say if it's a sit down restaurant where you go inside and sit down, which still keeps Taco Bell and those kind of places on the list, but they're trying to say if it's a sit down restaurant where you have to go sit down, then they're going to continue it, trying to get people back into restaurants. Well, the big thing about that is there's a lot of restaurants where they're not going to have sit down inside meals anymore. They're going to be a, you know, pick up and take it, or, you know, that kind of stuff. So there is talk of it. They can't seem to get this one bill passed anyway, so I don't know what's going to happen. The Build Back Better bill, it just can't quite get there. So, you know, I don't know what they'll do.
Does that qualify for gift cards to restaurants?
I have said yes to that, but I would not say that in most cases. Like, don't. Any other questions? The gift card answer, depending on what you're using the gift card for, could be advertising. I don't know what industry you're specifically in, but a lot of realtors use a, here's a thank you gift. Referrals are, referrals are great. That's more of an advertising expense than it is even a meal or a gift.
Sorry, go ahead, Brian.
I just had a question kind of off topic about any rumblings in the legislature to adjust or talk about the estate tax exemption for the state of Oregon, since it's one of the lowest in the country.
No, they like it, unfortunately. So there are some estate planning items. Oregon does have some good estate planning. If you want to spend the time and energy, there are ways around our $1 million cap. Okay, next question.
Well, going back to the gift card, I know aside from advertising, as you mentioned, but also businesses started purchasing those to help restaurants and just give it to the employees. For example, for holidays, they give it to the employees, or some organizations, they decided to purchase those and just hand it to other members. So I don't know why the gift card is not part of it's not included in the 100% deductible.
So you have to be careful. I'm going to give you the technically correct answer. For employees, if you're giving them gift cards more than $25, technically it's taxable income to them. So gift cards to employees can bear some consequences. Does everyone follow that rule? No, but just know that that's the rule. The gift cards, if you're giving them to someone else, meaning like if it's a networking thing or, hey, go try this out, or, those kind of things, I would say you'd have an argument for the 100% because it's a gift card to a restaurant. It's not like those visas where you can use it anywhere. It's a specific restaurant. And I do think you have a ground to stand on for an argument that it is 100%.
Okay.
Any other questions on meals?
And that's one of the reasons why we, as small business owners, should be, talking with a CPA, because they're going to guide us the which way we're supposed to go, and give us that, here's the boundary. If you stay under it, you're not going to get caught. You go over it, hey, you might get audited and you get in trouble. So, I'd always, refer back to our CPAs and verify with them what, is, for our business and what we're doing. So fortunately, I have a great CPA and she's in this meeting.
Thanks, Kevin. So last but not least, I have added my contact information. So if you have some questions or anything about the presentation, I've added my contact information on the back slide. So that way, if there is something that comes up, you thought about it, in a day or 20 days from now, please feel free to reach out and give me a call and I can answer any other questions you guys might have. Any other final questions?
I just want to thank Heather for taking the time out of tax season to come and share this with us, because this is important and, really impacts us as we go forward. So appreciate that. Thank you for being a part of our program. So
thank you. Thank you for having me. Thank you for doing it in January.
Thank you.
Deanna, any final things?
I think we're good. Thank you very much. I appreciate it. We do have obviously the Small Business Solutions Series will go throughout 2022, and we're finalizing and looking forward to programs that we'll be offering. And so if you have ideas, send them to me or to Kevin or to Titonian or any member of our Small Business Entrepreneurial Council. Have a great day.
Thank you.